So I think that's important, because when you see studies out there saying, well, if you try to time the market, you're going to miss the best up days. No one tells you that those best up days are usually during bear market cycles, that there are those knee-jerk relief rallies that really don't have any sustainability to them. So we're happy to miss those knee-jerk moves and just be there for the prevailing long-term trends. So if I were to describe the strategy at a high level, once we evaluate the sectors for these characteristics, long-term momentum especially, we will reward them with an equal weight position of about 12.5%. So we'll max out at having 8 sector SPDR ETFs in this strategy. And if we don't have 8 that are checking our boxes, well, then we'll move into a combination of those risk-off categories. And it's actually pretty interesting where the strategy stands right now, because it's somewhat, it's gotten to be almost like a barbell strategy, or somewhat market neutral, in that we have about 50% sector exposure. And it's the leadership from this year, especially technology, consumer discretionary, communication services. And then it's balanced out or sort of moderated by the risk-off categories. So a combination of the short-term treasuries, it's 1 to 3 year treasuries that we're getting exposure to there, the long-term treasuries and gold positions. And it will be ready to shift, in the way that the market dictates, right? So if we do see that breakout by the S&P 500 from what has become a big wide trading range. To me, one of the most difficult environments for investors is a trading range, not even a bear market cycle, but a big trading range. If we see that resolve higher, well, we'll see tech more aggressively shift into more sectors, getting up to those 8 sectors at some stage. Whereas if we see this correction turn into something much worse, we hope not, well, then we'll probably at least initially stay with the risk-off exposure, but then even build on that exposure until the market seems ready to make a more sustained advance. And over history, that has proven to be a good strategy, building on returns, but also doing so with a lower beta, lower standard deviation, smaller drawdown